when you talk from the older profession, because this street is famous for this.
Okay.
This is the street. You're in the right place.
Okay. Okay.
You're in the right, exactly in the right place.
Okay. All right. Okay. So, okay, welcome back. Let's finish this example of the variable fee approach. So we basically did before going to the coffee break the reconciliation of the insurance liability in the first year. So what happens there? And like I said, one item here that is different from what we have been doing before is that now we have underlying items, and this is a service that this is a finance service that the company is providing. Okay, so we have to identify that separately. What happens next? Well, this is from the table below. Then we have to put together the statement of profit and loss, and look at how it is constructed. We have two pieces. We have the insurance service result, and then we have the finance result. Okay, now here we will assume that there are other assets that the company has, and also they will be part of the profit and loss. But here we are just doing the accounting for this particular insurance contract, and what we have is that we clearly identify what piece is insurance and what piece is finance result. So if we look at the liability at year end, which we calculated in the last slide, then we have the 15,000, which is the premium. Then we have the increase of 1,500. Then we have the here an investment component which is 162, right? And we get to 320. So this 162 is basically basically the result of the fact that the pool was divided by 100, and then one person died, and the result was 162. So we identified that as an investment component. But this 320 can also be calculated in an alternative way. We would have expected insurance service expenses of 8. So 8 is the money that we need to put in, because we said the beneficiaries are going to get 170 minimum, but we have 162 in the account, so we put 8 plus 12, and 12 is nothing but the risk charge or the release, technically the release of a risk adjustment for financial risk for the first year. So we said it was 25, and then we released 12 in the first year. And then we have 300, which is what? 300 is the contractual service margin. So we can arrive at this 320 with this other methodology, and we are good. Now we have a couple of notes here. One is note A says that investment income related to the assets that the entity holds is accounted by a different standard. IFRS 9 or IAS 39, okay? Basically, it's going to be IFRS 9, but companies now are using IAS 39, okay? So besides these assets that belong to this insurance contract, there are other assets where the company has investments, and this is subject to a different accounting. And then note B, changes in the obligation to pay the policyholder an amount equal to the fair value of the underlying items do not relate to future service and not adjust the CSM. So that's the big difference, okay? So in other words, we are providing the policyholder with two services. We are providing him the insurance service, okay? And then we are providing a finance service for which we have a 2% compensation. All right, which is called, I think it was called the contract fee. So we have to make this separation, and so this is how the statement of profit and loss looks like. Now, do you think this is more or less straightforward to understand? Like do you think an investor can understand this easily, or not? Or it's a bit confusing? What do you think? Well, I think I don't know. Probably it's a bit confusing. I think investors are basically not of course not used to IFRS 17, and actually insurance companies are not used to IFRS 17 at this time. So there will be a full set of disclosures in the financial statements, and these financial statements have to be as clear as possible. But the problem is that right now we call premium everything. So premium is not only the compensation that we receive for bearing the risk, but also any deposits is part of the premium. So right now this 2%, which is a contract fee, goes under premium, right? And here we have a separation of the items. So it's, in a way, we have to digest this type of a presentation, and eventually we will understand it, and in the future, I guess, will be the standard. So it's not as, it's like mathematics. In mathematics, the first time you see a concept is very difficult. You need to digest the concept until it becomes clear. So mathematics is like entering a dark room. You don't see anything, all right? And then you don't know where to go, and then suddenly you find the switch, and then you turn the light, and then you see everything, okay? IFRS 17 is a bit like that. You're entering a dark room, okay? You don't see anything, but then somehow you find the switch, you turn the lights on, and everything is clear, okay? So again, recommendation is to, well, first of all, recommendation is that you need to read it, okay? So you need to read the standard, and make sure that you understand they have something that some articles are in bold letters, and these are the most important articles. So make sure that you understand all this, and also the slides will also provide some guidance, but keep reading, because there's a lot to digest. Now, another thing that we have to reconcile. So these are the changes in policyholder account balances, okay? And this is straightforward. I don't think there's anything magic about this. Basically, is the premium that we get, 15,000 altogether, then the returns on investment, or I think here we call it change in fair value, okay? The contract fee, which is the 2%, then the payment for debt claims, and then payments for maturity benefits, okay? And then at the end, we know that everybody's going to get back their account balances, and that's it. So this one is it's very straightforward, no difficulty. Okay, change in the fulfillment cash flows. Well, here we have new contracts. Okay, 795, and this 795. I go back a few slides. 795 is, where is this number here? So this is the initial 795. The difference in cash flows plus the risk margin, or the adjustment. Okay. Then I have effect of time value of money and financial risks. This we calculated in another table. Okay, and then we have the changes related to current service, which basically here since we don't have anything else, we have basically the amortization of the risk margin, and then the cash flows, right? And then the cash flows. Okay. So notice that in the first year, I have 14,830. I go back. No, 14,830, which is the difference between no, I don't have that explicitly.
Isn't it 15,000 less the claim?
15,000 less.
170?
170. Yeah, very well. Yeah. Yeah, very well. So 15,000 is what? The premium, and then 170 is the, thank you for that, is the claim. So that's the cash flows. Then in the second year, there will be no premium, so I only pay 171, and it's not 170, it's 171 because this was the basically the allocation to the remaining survivors. And then in the third year is 18,080. Now this 18,080, I go back, is also the sum of these two things. Should be the sum of these two things. One is the death benefit for the person who died, and then the other is the maturity benefits. Okay? And then this, so fulfillment cash flows. And then the last one is the the last one is the contractual service margin. Again, I start zero. I have the 795, which again is the same as the fulfillment cash flows. And the 1,500, the effect of time value of money there. And then changes related to future service. This is what is recognized in profit or loss, and should be very natural. Okay. And then these values, the 1,500, 1,281, these values here, this line here, was calculated already here, I think, here, and even here is the same thing here. Okay, so this is simply the increase in fair value. Okay, so we are here, contractual service margin, and that's it. Now here let's create a new exercise where we consider the set of assumptions of the example, and then the fulfillment cash flows at the end of year 2 are 16,461. Okay. Now, what would be the changes in insurance liability? Well, basically, the idea of this exercise is that we repeat everything again, or rather that you do it. Okay. But basically, we follow pretty much the same mechanic as before, and I think the only thing that is a bit tricky is there are two things that are tricky. One is this 41, how this 41 is calculated, but then we have that here the explanation. Here we have this number here, 1,281 minus 1,214. And this is the difference between the change in underlying items and the change in fulfillment cash flows from one year to the next. So this is 67, but then we are putting 26 there, so the difference should be 41, and that is what we put there. Now, what is 26? 26 is what the insurance company is receiving for, how is it called? The share in underlying items. Okay, so basically we are multiplying this number here times 2%. Of course, with different sign, the opposite sign. So 1,281 times 2% is the share of is whatever the insurance company is getting. Okay. Yeah. Yeah. And the rest is again like the table before. Now notice that now how the recognition in profit and loss is calculated. Now we have 99 survivors, but we expect to have 99 and 98. So Here we are dividing 99 by the sum of 99 plus 98, and this is about 0.503, and then this 659, which is the contractual service margin before recognition in profit or loss. So in other words, this 659 is this number plus this number plus this number. Or here, I think we have it here. 592 plus 26 plus 41 is 659 multiplied by the service provided in that particular year. Okay, that's the way it is done. So that's the recognition in profit or loss. Now for the next year, we expect also that one person is going to die. So we will have, instead of 99 divided by 99 plus 98, we will have 98 divided by 98, which is 1, okay? But it's the same thing. So are you happy with this table, more or less? Mm-hmm. Okay, so let's look at the third year. So the third year, again, we start opening balance with the carrying amounts that we have at the end of the second year. We have the benefit paid. We have this 34, which is this number times 2%. That's this number. Okay. Then we know the difference between the change in underlying items and the change in fulfillment cash flows to be 53, 34 of which we are already recognizing. Then the difference is 19. So we call this effect of time value of money and financial risks. And then in the third year, the entity provided the remaining 98 units of coverage. Since this is the last coverage year, the entire 380 is recognized in a profit or loss. And then sort of a magic, I get zeros, right? So I think everything worked okay. If I don't get zeros, there's something wrong with my calculation. But this indicates, well, even if I get zeros, it's not a sufficient condition to prove that I'm okay. But at least I'm not wrong. Okay. And that's it. Do we have a summary? No, we have no summary for this example. Okay. So what have we seen now? We have seen the variable fee approach, and then again, you are acting as provider of insurance coverage, and also you are acting as a financial provider of financial services, and well, basically, these individual accounts have they grow by underlying items, and then you charge a so-called contract fee, which in this particular case was 2%. Now, this fee can be constructed in many ways. You can charge different fees for different parts of the change in underlying items, or you can charge a different fee in the first year than in the second and third years. It doesn't matter. It's just here for simplification purposes, we put 2%. Could have been a different number, a different approach, but the concept is the same. Now, another thing that is worth noticing is that that these policies have the same size, right? But if they have different sizes, we need to take that into consideration for the allocation of the contractual service margin and the units of coverage. Okay, questions here? Yes, Brand?
How did the, So in lots of these policies, if the client is unable to pay premiums, you're unable to withdraw the premium from the fund. So let's just say in year 3 that the premium due was $10 and the fund is $160 and you just took the $10 from the $160. How does that get reflected in this PV cash flows column and the CSM column?
Well, why premium the third year? Well, in this particular example, the premium, it was a single premium contract.
Yeah, so let's just say there's regular premiums.
If it is regular premiums,
And the client
okay.
is unable to pay anything, and you take it out of the fund.
Okay. So it's you take it out from the fund, which is what happens so some universal life policies are like that. So how could we reflect that in the cash flows? Well, basically we have to to begin with, I go back. So we would have to basically reflect here the fact that the premium is not single premium, but is a periodic premium, and then we have to basically adapt everything to our expectations. So our expectation here is that we are going to have 99 survivors at the end of the second year. So we are going to receive, if it was periodic premium, so the premium would be 99 times 150, all right? So we adjust that. But what happens if the premium is not collected? You say the premium is not collected, right?
It's paid from the fund.
It's paid from the fund, yeah. So that's going to basically have, I don't think this is going to have an impact because so I expect this, so I expect the premium to be part of the cash flows, but it wasn't there, right? So I may very well have an assumption of how many people are going to be able to pay the premium, right? So I would do that, and then I would deduct from the underlying items the amount of premiums that I think are not going to be collected, right? So if they are not collected, they are paid from the fund. But then what happens if the fund is not sufficient, right? Well, in the US they have something called secondary guarantees, and even if the premium is not sufficient, the policy stays in force. What we would do here is that I would cancel the contract if the premium due is larger than the account balance. Yeah. But then, what's the complexity here? The complexity is that I need another set of assumptions to account for how many people may not be paying the periodic premium on renewal, right? Okay. Anything else regarding this point? Okay. Then this is very simple. This is called the PAA, Premium Allocation Approach, and it's one of the methods. Again, one of the measurement methods. And basically, when can we use this approach? Well, they say the standard says that it can be used when the resulting liability for the group will be similar to that produced by the general model, which is already a complication because that implies that I have to do the general model and then also the PAA, or at least have some idea whether the result would be similar to that produced by the general model. Okay, but here, basically, the one rule is that if there's significant variability in the claims experience, then you may have a big difference. Okay, and also condition number 2 is that this is only for contracts that have a duration that is up to 12 months. Okay, so basically for general insurance, you can use the PAA if certain volatility conditions are met. And again, there's a bit of subjectivity. They don't tell you how to calculate this volatility condition, but basically that's how it is done. Now, for the PAA, you only have liability for remaining coverage. There's no contractual service margin. Let's look at an example of how this works out numerically. Okay, so here the liability for remaining coverage is like works like you know the concept of unearned premium reserve. So basically, the unearned premium reserve is basically a reserve that you establish because the premium has not been earned. Okay, we say in Spanish devengada. No ganada, non ganha. Okay. Okay. So we have basically this diagram, the premiums received plus any additional onerous contract liability, we basically have to deduct deferred acquisition costs and premiums receivable. Okay. So it would be similar to that, but with this adjustment. Okay. Now the other is the liability for incurred claims. Okay. Oh, sorry. Here it should say incurred claims. So we have the risk adjustment and the discounted present value of cash flows. Okay. So this would be like a claim reserve. So whereas the first one is like a sort of a unearned premium reserve, this one is a claims reserve. Okay. Now, you will be very happy to look at this example. It's the easiest example in the course, right? So here we have again insurance company that issues 100 contracts. They are identical. The insurance contract are of duration 9 months. Okay, 9 months. Nothing to do with the gestation period of the human life. It's just 9 months. And this contract starts on the 1st of July of 2019 and runs until 31st of March 2020. Okay. Now, the total premium is 15,000. The acquisition expenses of 450, and then we classify this group as non-owners. Okay. Now, subsequently, we found claims of 7,500 during the second half of 2019, and then 5,000 during the first half of 2020. Okay, and then we have the risk adjustments of 450 and 300 respectively, and then again here I'm taking, I'm already providing you with these risk adjustments without disclosing how they were calculated, but what we want to know is what's the accounting mechanics, right? Now, on June 30th, 2020, so this is 3 months after the contract terminated, basically the entity says we're going to settle all the claims by paying 13,400. Okay, so at the end we are going to receive 15,000 in premium, and then we will have to pay certain expenses, okay, and then we will have to pay certain claims, and at the end we have a profitable contract.
This would be the ultimate losses. This 30,040 would be the ultimate losses.
Yes. Mm-hmm. So here we have a balance sheet, okay, and in the balance sheet we put cash, okay, 15,000 that we received, okay. This cash account stays the same, and then we have basically the deduction of the payments that we had to make. Now we have the insurance contract liability, and then the balancing item is the equity or the capital. Now, how do I calculate this insurance contract liability? Well, basically what I'm doing is that I am taking the proportion of the contract that in the first in up to the 31st of December. So how many months we have in the contract? We have 9 months. How many months have elapsed until the 31st of December? 6 months, right? So 6 months out of 9 is 75%. So I multiply 15,000 by 75%, okay, to get that number, okay? So let's see here. the changes in insurance contract liability. So we have the inflows, which is the premium, okay? Then we have insurance revenue, okay? So this is the 15,000 times the 75%, or the 6 out of 9. So in other words, the insurance. What I'm doing is that the name of the method or the approach is called premium allocation approach. So I have wherever I have premium, and get used to it. Whenever I get premium, this premium is now it's kind of a liability, right? So this liability is distributed like that by coverage. So I'm doing an allocation of this liability 6 months up to the 31st of December, and then 3 months afterwards. Okay, so I have this is the liability for remaining coverage. Now, what about the other part of the liability? This is the liability for incurred claims. Well, we were told that that we have 7,500 in the first 6 months, and then we have 5,000 in the second half of the year. And look at the reporting dates, okay? And then this 900 is basically the I think we settled the liability for 13,400. Okay, so the sum of this row should be 13,400. Okay, so and then we have the risk adjustment for non-financial risk, which was also given to us, 450 for the first part of the year, 300 for the remaining part of the year, and that's it. Okay, so this is the trick here is to allocate or distribute the premium, the liability, according to the portion of the contract that was basically alive until the reporting date. Okay. And yeah, and the present value of the cash flows considered the claim received at the reporting date. Mm-hmm. And no time value of money calculations. Of course, that I have to here in this particular example, I'm saying the risk adjustment is going to be 450 and 300. But then again, I could say that in the second reporting period, or in this case, the reporting is done every 6 months. I can say, well, I have revised the risk adjustment, and it's a different number. That could very well happen, and of course, I would do the adjustment. But the thing is that as in the general model, we had this concept of a contractual service margin, and then I was recognizing this as time progressed. But here in this premium allocation approach, all I do is that I distribute this liability I assign the premium or I allocate the premium to the reporting periods. Mm-hmm. And premium becomes a liability, right? Any questions here?
Will I have a change in the loss ratio metric?
Mm-hmm.
Because nowadays from a loss ratio perspective,
Yeah.
that's pretty useful, right? So we take the claims,
Mm-hmm.
compare with premium,
Mm-hmm.
done. Right? So splitting this, will I expect that to change in the loss ratio, or I continue with the legacy view of the loss ratio?
The thing is that there's an interconnection between premiums and claims. Why? Because what I'm charging ultimately is some number that reflects the premium, that reflects the claims that I'm going to pay. So here my expectation is to pay something less than 15,000, but then the claims turned out to be 13,400. So 15,000 was probably a good estimate of the claims. Of course, I also have to make money. So what I do is that the premium becomes a liability, and this is what I distribute. And the loss ratio, what is the loss ratio? The loss ratio is basically the claims divided by premium. It's basically that, right? So what I want to say is that the premium and claims are interconnected, and the premium is now called, in this IFRS 17 vision, the premium is liability. If I receive a premium, this is a liability, okay? Because I owe this to the policyholder. Now, some part of this I will not pay, and that's basically that's my profit, right? But in principle, I expect that I will, I take the approach that if I receive $1, I will have a liability of $1, okay? And I will, I will be paying this liability will be getting smaller and smaller, and there will be some portion of this liability that I don't have to pay, and this becomes my profit.
May you step one slide back?
Here.
Okay, so I expect claims for 12.5, right, over a premium of 15. So 12.5 over 15 will be my loss ratio for the overall 100 insurance contract portfolio.
Yes.
Right?
Yes.
If I put these on calendars, I will have a difference between the years, right? Or I will keep the same ratio-ish. I was not able to
So you're saying that well, no, the thing is that here when I do the the problem says as of end of December I had 7,500. So these claims were incurred and already by that time. Okay, so here I'm not very concerned about the. What I'm doing here, I just look at the premium, and then at the end of the reporting period, I see what are the premiums the claims that have been incurred, and what I distribute is the premium. So this is the basis for the calculation. I distribute the premium, which is a liability, and then I look at how many claims I have. So here I'm not projecting, right? Or in a way, I will have to do some sort of projection because this 15,000, where this 15,000 came from? Well, evidently this came from some sort of projection, right? Some sort of analysis, and I believe that if I charge 15,000, I'm okay, right? But then I simply go to the end of December, and then I look what were the claims, and the claims were 7,500. That's the way I do it. If the claims had been, instead of 7,500, let's say they were 8,000, then I simply put 8,000 here, and that's it. No. So how is that going to impact my profit? Well, basically, this is this will be these numbers are sorry, here I have the insurance service expenses, okay, and somehow I have the claims there, right? The claims are here. If the claims are here are higher, the service expenses are higher, and then this number is also higher, but this is negative, so the profit is going to be lower, right? So I always look at the past, look at what were the claims. If the claims were higher, and actually this is, in the next edition of this seminar, I'm going to put an example. Now suppose that the claims are not 7,500, but they are 8,000. And then how to re-express the results, okay?
Yeah, the 100 contract have a 83% loss ratio as a total.
Yeah,
It's basically the same because we are amortizing the revenue and allocating the claims.
yeah.
Then talking about the claims, we are saying that we expect to have 7,500.
No, we have. No, we expect. We have.
Ah, we had.
Yeah, look at the. Yeah, there were claims.
Okay, so the numbers I have in that approach is what I really have. You know,
Yes.
what happened with the IBNR, by the way, on
Ah,
IFRS? Should I consider that on the...
Well, yes, yes, because what I have to do is that incurred claims, right?
Mhm.
Yeah. So what happens with IBNR? Do I need to calculate IBNR in IFRS 17? Yes, I will. Right. Thing is that I will not explicitly identify it, but then it's part of my incurred claims.
Okay, so clear. For
Mhm.
illustrative purpose, here only the claim incurred.
Mm-hmm.
For a practical perspective, for that amount, I should consider the claims
Mhm.
that occur
Yeah.
naturally.
Yeah.
And also estimate some kind of IBNR.
Correct. Yes. Yes. That doesn't change. That doesn't change. You still have to do it. By the way, we will not use premium in the financial statements any longer, but so it's not in the income statement. So here's the income statement. Where's premium? Where's the premium? Nowhere to be found, right? And what was the premium, by the way? The premium was 15,000. Under traditional accounting, I would be looking for 15,000 there. On the traditional accounting, under new accounting, where's the 15,000? No place to be found. But anyway, the 15,000 are called premium, and they will be.
Insurance revenue.
Yeah, but the premium will be recorded anyway, because also I have to pay the agent some percentage of the premium, the commission. So the premium is going to be is not there. It's like here behind the scenes, but the premium still is very relevant. The same for the IBNR. Where's the IBNR here in the balance sheet? Where's the balance sheet? Where's the IBNR here? It's not clearly, it's not explicitly identified. But do we have to calculate it? Yes, you will. Right? So you will you will be operating with your premium as normal, and your IBNRs and everything, and you unearned premium and your deferred acquisition costs. These things won't change. So you still have to keep that in some system of some sort, for sure. And also you will have to do your reporting to SUSEP. I don't know, are they going to collect the insurance revenue, or they are going to collect premium? My guess is that they will be collecting they will be, for statistics, for industry statistics, they will be asking you about your premium, right? But then if I send SUSEP this page here, okay, can they know which one is the premium? Well, they could if they sum the insurance revenue of all reporting periods. But suppose that I send to SUSEP only this part, the first column. Which premium are they going to put in the statistics? Because in fact I receive 15,000 in cash here, but where are the 15,000? That's the thing that we are going to we need to get used to these things. We receive cash payment of 15,000, right? The thing is that I distributed, I allocated it, yeah.
In that way, the premium deficiency test we used to have in the past is no longer necessary once we have the margin.
Right. It's no longer, yes.
For the PAA approach, we should continue doing
No. Yeah. And then again, one other thing is that this is a 9-month contract, but I charge the premium. It was a single premium contract payable at inception. Okay. Maybe I could argue that what if the contract is sold through a periodic premium? Then it's a different approach, but then should be analogous to this one. We keep it simple and we say single premium. Okay. Any other question here? Okay. Now let's talk about, we haven't talked much about presentation of results, which is the next item. Okay, so, but I already, and thanks for this question, because this gave me the chance to talk about the fact that premium still has to be managed, still has to be collected, registered, and everything, and it will be the basis for reporting statistics to SUSEP, also the basis for paying commissions to the agents, to the brokers, whatever. So premium stays the way it has been always managed. However, it's not explicitly identified in the profit or loss. So we have seen simplified profit and loss, and this is again, we saw this this slide before. So in the traditional world, we see premiums, okay, which normally are called gross written premiums. We see premiums ceded to reinsurance. We see net written premiums. We see a change in unearned premium reserve. All these things have to be calculated somewhere, but the income statement will not be that, right? So we should be clear on this aspect. Okay. Now let's compare 4 with 17. Okay. So 4 responds mostly to local accounting rules. Is not a global standard. Okay. That's why 17 was necessary. Okay. Now let's do a comparison and again talk about the example with 100 policies. I think this is the same as the participating contract. So there's a single premium. Then in case of death, beneficiaries receive the larger of the account balance or 170. Okay, whichever is largest. Then there's a maturity benefit. So if the policyholder survives until the end of the coverage period of 3 years, then they will receive the account balance. Okay, and also we assume that one policyholder will die in each of the 3 contract years. So it's similar to the last to the participating contract example, and then let's see how in the upper part we see the IFRS 4. The IFRS 4 income statement. In the bottom part we see 17 income statement. So that's the difference between the two, and at the end the profit is going to be the same, right? It may not be the same. It may not be the same because there are other elements that IFRS 4 is not considering. But in this simplified case, I say, well, let's assume that the profit is the same. Now, what's going to be different for sure is the distribution of profit. Okay. Now, in this particular example, it seems that profit recognition. I have more profit in year 1 under 17. I have less profit in year 2 under 17, and I have about equal profit in year 3. Okay. Now this should not. We cannot reach any conclusions here. This is just how it worked. We cannot reach any conclusions. The only thing that is apparent is that 17 will be more prone to profit deferral. Okay, it's not shown here. Here it worked out. Here it worked out to be the other way around. So there's a little bit more profit towards the beginning. Okay. But look at for example the premium. The premium I have under 4. I see the 15,000 clearly. Okay. In the first year. But I see no premium in the second year, no premium in the third year. Under 17, I see insurance revenue. And by the way, these insurance revenues are calculated in the example of the participating contract. Okay. Then I have claims and expenses. we see clearly here a huge difference between 4 and 17. As a matter of fact, under 17, I had these $8, which was basically the difference between the death benefit and the minimum guarantee of 170. And that's it. The other major difference is that insurance finance expenses that we don't see in 4. In 4, we see something called investment income. Okay, but this investment income is well, this is sort of this is the same investment income, but cancels out with the insurance finance expenses. Okay, so there's no insurance finance expenses at the end is 0, and this is wrong. This should be insurance finance result, not expenses. This is result. Okay. So that's kind of a light comparison between 4 and 17. I think the key message is that we will be thinking like this for many years to come, but we should present results like that. Okay, which is a different concept. This is what we are going to get used to. Okay. Now, is this practical? Why this change? Well, it has been a very, very long time to develop the standard, and there are many considerations. It's believed that it's going to be better for the industry. Let's see what happens. It's going to be interesting to watch the developments in the next few years. Now, we have here a better or a more complete profit or loss statement, and basically, we have here the insurance revenue of the remaining coverage. Okay, so this in this case we have. I think this is one of the early exercises where we have. I remember distinctly this profit, 26.62. I think this was probably the base example. I think, but basically here the illustration is the format, or this is kind of a template for your profit or loss. Okay, of the insurance contract. Okay. Now, where do you have, you may say, where do I have, I don't know, depreciation charges? Well, depreciation charges are not considered here, right? This is only accounting for the insurance contracts. Of course, your company is also going to depreciate some assets, and this has been this will be treated by a different standard or a different accounting rule. Now, one thing that is worth noticing is something that is called investment component. And what is an investment component? This is a payment that the policyholder receives even if there is no insurance event. So the insurance event is normally what triggers an insurance claim. But here, investment component could be anything. Could be a cash value, could be some return of proceeds. It's not necessarily that the policyholder died. And here we are assuming, just for convenience, that this is a flat 70. Okay, could be higher, could be. It doesn't matter, right? The thing is that remember that in the first example we have 150 in claims every year. Well, this 150 is the sum of 70 plus 80, right? 70 plus 80. And then, I think this is the non-onerous contract. This is the contract that had favorable experience. So 70 plus 70, 150, 70 plus 60, 130, 70 plus 60, 130, 70 plus 60, 130. Okay, so basically we're splitting the payout in two parts. One part is the sort of the death benefit, and the other part is other payments made to the policyholder. And then we have the insurance service result, which we know already how to calculate, and insurance finance expenses, and then profit or loss. So whereas we used to have a profit or loss statement which was insurance revenue minus insurance service expenses. Now we have a lot more here, right? If we go back a few slides, a few presentations rather, we would see that we only have these two lines in the past. We had the insurance service result here, and then we have the insurance finance expenses. And these two, the net of the two were this. Now we have this new investment component, and then here for clarity, we are basically doing the development of the insurance revenue for the remaining coverage. Okay. Now, balance sheet. Okay, statement of they call it statement of financial position since many years. People still call them balance sheet, and I think I think we will live with balance sheet for many years, but I don't know why they call it statement of financial position. Perhaps it's a better word. I don't know. Yeah. So they don't call it balance sheet. They call it statement of financial position. But this is not new. This has been around for many years. Okay. So here we have 4 versus 17, and I think we have seen this before. Okay. So the balance sheet of 17 is simpler, I would say, although we are very used to number 4. Now, main changes in liabilities. This one is important. The groups of insurance contracts that are in an asset position are presented separately from the groups of insurance contracts that are in a liability position. Okay, so we have to make this distinction. And in the measurement of liabilities are things like acquisition cash flows, okay, which are acquisition cash flows is, it's another word for commissions, right? Then we have also premiums receivable. So the premium is prohibited to put premiums receivable. It's not that we are not going to have them. Of course we will have them, right? It's only that we are prohibited from identifying these terms explicitly. They will be included in the assets or liabilities, okay, and unearned premiums. Now, insurance revenue, okay. So insurance revenue, I go back. Insurance revenue is this part, okay. So this is the insurance revenue. And we're going to talk about these elements. Okay. Now look at before going to the text. Let's look at this intuitively. Now accountants are usually they compare opening balance and closing balance of a asset account or liability account, and then this difference may flow to the profit or loss. So here we start with the closing balance of the insurance liability, and then we compare it with the opening balance. Then we add the insurance finance expenses, we add the inflows, and then we have only the investment component, right? Because this is revenue, okay? The other part would be the insurance service expenses. So let's talk about this paragraph here. This paragraph, this is called insurance revenue. So I move forward, and then we are here, presentation of insurance revenue. And then we have certain paragraphs. So number 83, these are the premiums paid to the entity, okay, adjusted for for a financing effect and excluding any investment components. Okay, so the 70 that I had to pay, right? That's insurance revenue. Insurance expenses include incurred claims, but without investment components. Why? Because the investment components we have in the revenue. Then we have expenses related to the claims, unallocated and allocated loss adjustment expenses, amortization of cash flows. So amortization of acquisition cash flows. This is also called DAC in English, deferred acquisition cost. Yeah. Changes that relate to past service, etc. Changes to relate to future service. Those, just as we have been doing in before. And then the investment components, amounts that an insurance contract requires the entity to repay to a policyholder, even if an insured event does not occur. So this is the language used in the IFRS 17. Okay. So revenue and expenses shall exclude any investment components. Now, the contract liability, okay, so we have our friends here. What are our friends? Our friends is liability for remaining coverage, liability for incurred claims. This is insurance liabilities. Now, all these things here, all these boxes here, have to be put into any of these boxes, right? So, opening balance of the liability minus insurance revenue plus insurance expenses plus investment components plus cash flows is equal to closing balance of the liabilities. Okay, so it's kind of makes sense. I think I like it when I see it, and everything is matter of allocating these components to the boxes below. But they go as far as telling you, well, you have to explicitly identify the components and then allocate them. Okay. And then one part that is very important are the notes. Okay, so here we say that we have to disclose the reconciliations of the net assets or liabilities for remaining coverage, loss excluding the loss component, then the loss component, and then the liabilities for incurred claims. Okay. Except where the premium allocation approach has been applied. Mm-hmm. Good. Okay, so this is the example that we have. It's one of the early examples that we have. We are already familiar with a table like this. Basically, in the insurance liabilities, well, let's pay attention to this last column. Okay, and here I'm doing basically everything with loss component. Now here there's no loss component, so there's it stays about the same. But I'm separating everything between remaining coverage and incurred claims. If I go back, here I have the insurance liabilities, but there's no separation between remaining and incurred. Okay, so I have the typical components, which are the present value cash flows, the risk, and then the contractual service margin. Okay, everything, the sum of the three is the insurance liabilities. But the insurance liabilities have to be split into two, remaining coverage and incurred claims. So this last column is what I split in two. All right, so pay attention to this last column. And here's the split in two, right? Now, the split in two expanded with the loss component. Here, in this particular example, there's no loss component, but if there was, we should have some numbers populated in that column of a loss component. Okay, so, and then if you're not going to have a loss component, you simply don't put the column, or you may if you want to be very, very explicit. Okay, and then notice that the investment component basically basically you have a minus 70 and then a plus 70 in incurred claims here. At the end, you will have your outflows of 150, and that's it. I think it's going to be more interesting when we calculate the loss component. Okay, so again, this is very similar to what we did in the past. We do the reconciliation of the insurance of the revenue for the remaining coverage. Okay, but here we have the investment components, and then again we say this is an assumption in our example. In real life, I will have to calculate it. Now, what if this group of contracts becomes more profitable? I think this is what we did yesterday, but now we need to do the analysis, including disclosure of the insurance revenue for the coverage. So again, the chapter that we are dealing with now is the disclosure of the insurance revenue. Okay, something that we didn't do yesterday. Okay, so what I have here is basically the expansion of the the split of the insurance liability into remaining coverage and incurred claims. And then remaining coverage has been expanded to include loss component, but there's no loss here. Mm-hmm. Then part of the disclosure, so this is the insurance revenue has to be disclosed in the notes to the financial statement, to financial statements. Mm-hmm. So here's the, without the attribution, right? Then again, the 70 is an assumption. And the full profit or loss, okay? Now the profit or loss account statement looks busier than the ones that, remember in the past we have only 2 lines. Now we have a full table. And then we start with the revenue, and then the revenue is the change in opening balance and ending balance of the liability, plus the insurance finance expenses, plus the inflows, plus the investment components, or less the investment components, rather. And then we have the insurance service expenses, right? We have the insurance service result, and insurance finance expenses. In the past, we dealt only with insurance service result and insurance finance expenses. So what we are in fact doing is that this number 72, we are basically reconstructing how this number was calculated. All right. So we are, from a very easy profit or loss, we have now sort of they won't tell you that, they won't give you the official template. So if you look at if you try to look at the template, you won't find that. This is a suggested or a possible way of presenting the profit or loss. They tell you what they do is that they tell you in words what you should include and what you should disclose. So pay attention at paragraph 100, which is important in this context. Okay. Then if the contract becomes onerous, then there's the loss component. The loss component has to be explicitly indicated in the notes. Okay. So the loss component determines the amounts that are presented in profit or loss as reversals of losses on onerous groups and are consequently excluded from the determination of insurance revenues. Okay, so we are here in this world on favorable experience, same construct as before. Okay, same thing as before. So this table we constructed yesterday. If we look at the last column has to be split between 2 things. remaining, and unincurred. But then we also have to identify loss component. Okay, so here we have basically the methodology, and probably one thing that we are not that we need to indicate how to calculate is the 34.26 of the loss component. And basically this is an allocation, which I have in the next slide, I think. Everything else is straightforward. Okay. Everything else is straightforward. We know how to, we know the mechanics of everything. Okay. Of course, we also have one more row, which we didn't have yesterday, which is the investment component, 70 given. Okay. So the only mystery in this table is 34.26. That's the only mystery. Okay. Still remains a mystery until the next slide. So this is the insurance revenue. Okay. So I have the differences in opening and closing balance of the liability. Okay. I have the service expenses, the finance expenses, inflows, nothing, investment components. Okay. And then this 34.26, still a mystery. Okay. Still a mystery. Let me jump to the calculation. Here, letter C. It's given. Yeah. I have to letters. How is this? This would be an allocation of the. Let me think. This would be an allocation of the 34. Have here. 34.26. 34.26. Let me think. This is the part of the insurance service expenses that is allocated to. I have to divide. Let's talk about that after the break, because anyway we have to finish in a minute or two. So we still have to disclose this number, and we will continue with the. Okay, so this is the calculation of the insurance revenue for the remaining coverage, and we will yeah, because I have here the same number. Yeah. Okay. So I think this is the way I do it. This 34.26 is what I have to do is to calculate the original. Right, the original and the recalculated first cash flows and then risk adjustments. So I have this table here, where I have the original, recalculated with the new information and the original. Then we have the risk adjustment for non-financial risk, recalculated and original. And then the contractual service margin, and the balance of these items is 34.26. Okay, so yeah, I wonder why. Can I have a better approach to that? Let me think. Yeah, what we are doing in essence is that we are comparing the new cash flows with the old cash flows. We are calculating the new risk margin with the old risk margin, and then we add the contractual service margin to that. And then the net of these amounts is 34.26. So that's the solution to the mystery. Okay. Okay, I'm going to, so we know that already. We know this. And let me stop at this point. When we come back, we will ask if there are any questions, and we will look at them and finish this this presentation. Okay. Okay. In that case, enjoy the lunch, and see you at 1:30.